Federal Reserve officials appear to have tipped their hand to their interest rate strategy going forward, and it's not good news for the stock market. Recent comments make it appear they are willing to let the stock market crash and won't be turning the money printers back on to save it. But beyond the stock market, what will their strategy mean for the housing market? We'll be covering all that in today's video. Let's get into it. There's a lot of speculation about how far the Federal Reserve is willing to go to fight inflation. Some think they're not serious at all because they'll crash the stock market, housing market, and the economy overall if they raise interest rates anywhere near where inflation is running at today, which is likely what they would need to do to really bring it down. Some think they'll keep raising interest rates until they break the stock market. Then they'll pull back and might even go back to easy money policies. What I try to do on this channel is not to speculate too much and instead create some scenarios based on what they are signaling they will do. If you're new to this channel, my name is Eric and I'm a professional private sector economist in addition to being a licensed real estate agent in the state of California. So I bring a unique perspective to YouTube that you're going to be hard pressed to find on other channels. In my recent update on when the housing market could crash, I highlighted how public statements by Federal Reserve officials will be key to watch in the days and weeks ahead until their June policy meeting, and they have started to come in already. The public statement started coming in last week when Fed Chairman Jerome Powell said in an interview that getting inflation under control could cause some economic pain, but remains his top priority. And that the soft landing that everyone wants them to pull off is going to be difficult to accomplish. It's worth noting that Powell defines a soft landing as getting inflation back to 2% while keeping the labor market strong. That last point is an important one to keep in mind. They're not just looking at the rate of inflation, but they're looking at the labor market as well. Here's a chart for the headline unemployment rate, which has trended back to pre-pandemic levels. This metric is a bit misleading, however, as it does not take into account people that have dropped out of the labor force, which is almost 500,000 people below where it was in February of 2020. Not quite a full recovery and far below where it would have been if the pandemic-induced plunge in the labor market had not happened. That being said, they will still take this metric into consideration, so that is something that we're going to do as well as we assess future Fed action and how it will impact the housing market. And right now, this low unemployment rate is giving the Fed a green light to keep raising rates. Powell followed up those comments this week by emphasizing that the Fed will not hesitate to keep raising rates until inflation comes down. A lot of people are skeptical about how serious the Fed's intention is here, but whether we believe they're serious or not, this is what they're communicating to markets about their intentions. This point was hit home just a few days later when Kansas City Fed President Esther George told CNBC in an interview that higher interest rates are needed now to bring down inflation and that policymakers are not focused on the impact that is having on the stock market. She's basically saying that the Fed is willing to let the stock market crash if that's what it takes to rein in inflation. On any other day, you might write that off as just some bold talking, but keep in mind that these comments came just a day after the stock market had its worst day since 2020. I find it hard to believe that she was unaware of this when she did her interview with CNBC. These Fed officials know very well the power their words can have on financial markets, and she said them anyways as the S&P 500 was on the verge of entering a bear market. At this point, you may be asking why the Fed would not be concerned with the stock market crashing. It's because of something called the wealth effect, and there are a lot of people that think that the Fed's intention is to crash the stock market in order to bring down inflation. The idea goes like this. When the stock market is high, people see their investment portfolios and 401ks higher, and they feel wealthier. They'll then go out and spend more because they feel like they have more money, even if the gains are just on paper. The increased spending can then lead to higher inflation as demand for goods and services is higher. If the stock market goes down, the opposite happens. People feel less wealthy and then pull back on spending. This then leads to lower demand for goods and services and prices go down. So essentially, the theory is that the Fed is planning on bringing inflation down by bringing the stock market down. This would allow them to fight inflation without raising interest rates so high that they bring the entire economy down. Now, I'm not totally convinced this is the case, but I'll admit that the idea has some merit. If this is what they're actually doing, then in my opinion, the job growth and unemployment rate data will be the key indicators to watch. As long as the economy keeps adding jobs and the unemployment rate doesn't rise, the Fed is likely to feel very comfortable with their current path of interest rate increases at 50 basis points. So now, what does all this mean for the housing market? Well, if this theory about what the Fed is trying to do is true, it is actually good news for the housing market in terms of avoiding a full-blown crash in prices of 30% or more. In my last housing market crash update, I laid out my scenarios for where things could go, depending on what happens with inflation, the Fed's response to inflation, and mortgage rates. If the Fed is able to bring inflation down by just raising rates by 50 basis points at each meeting and keeping up their tough talk in between meetings, then that would essentially be my baseline scenario where mortgage rates get to about 6% by the end of the year and home prices would decline by 14% by December. That may sound like a big correction in home prices, and it is, but I'd say it's a lot better than a full-blown collapse in the housing market. What do you think? Is the Fed trying to crash the stock market to change consumer psychology to bring down inflation? And if it is, do you think they can pull it off? Let me know in the comment section below. Now, some of the key metrics we'll be watching in the next few weeks to give us more clues about how all this will unfold will be the government jobs report on June 3rd, which will give us new job growth and unemployment rate data. Then the Consumer Price Index report will be released on June 10th and give us new inflation data. That report will be closely watched as the previous report showed the rate of inflation had slowed from 8.5% in March to 8.3% in April. Will that downtrend continue, or was it a blip in the data and we haven't seen peak inflation yet? And then the Federal Reserve will have their Federal Open Market Committee meeting on June 14th and 15th where they will decide changes to their interest rate policy, with Fed Chairman Powell holding his usual press conference after the end of the meeting on the 15th. I'll be covering all these releases and let you know what their implications are for markets going forward. And later in the month, I'll do my comprehensive update on my market crash scenarios with all the new data. If you want to see those videos as they come out, make sure you're subscribed. Hit that notification bell down below so you know right away when they are released. And if you've enjoyed this video, please give it a thumbs up and share with others to support the channel and help it grow so I can continue to bring this content to you. Thanks for stopping by, and I'll see you in the next video.